Hello investors and future investors, welcome to the channel. In today's video, I will show you one option strategy that if you're trading with a small account can be extremely beneficial. Now this option strategy can be used on any stock or ETF. So if you're new to the channel, thanks for stopping by. On this channel, we help you with option strategies that can give you consistent revenue and everything related to finance and investments. And yes, you too can make money from your living room with options trading, and I'll show you how. And all I ask in return for this free content is an early thumbs up by you hitting the like button, and consider subscribing for more ways to win with options. Welcome to Investment Gains. Let's jump right into it. I would like to start off today's video by welcoming all our new subscribers to our community. Our small community focuses on option strategy that gives us weekly revenue. So thanks for sharing in our journey. So today's strategy is going to be used if you only have a few $100s in your portfolio. And our stock for today's demonstration is going to be Amazon, ticker AMZN. Okay, so here we are on Amazon, and as usual, we're going to go into our trade Amazon options in order for us to open up the Amazon options chain. Now, we're going to start off this strategy with a sell call. This is going to be a two-leg option strategy. So now that we have sell call, firstly, we're going to need to choose our strike date, and our strike date, we're going to go 1 week out, which is going to give us around September 24. Now, Amazon is one of those very good stocks for trading, and it is up about $5 today. However, I would not recommend you doing this strategy on Amazon quite yet because it's very volatile right now. Now, the reason why I want to start off this with a sell call is that whenever you're doing the sell call, you do get the chance of profitability given to you below. Now, if I jump over to buy and call, you're going to see the chance of profitability has disappeared. So if you're trading by looking for a chance of profitability, I advise that you always start with a sell call. Now, as usual, I'm going to look for a strike price that's going to give me a chance of profitability of around 75% or higher. So here we're going to have the 35.30. Now for the 35.30, we're going to be receiving 19.78 or 1,978. Now the reason why we're going to be receiving money is because we're going to be selling a call. As you know, if you sell something, you're going to receive money. Now let's jump on to the second leg of this option strategy, which is going to be buy and call. Now we're going to choose our second strike price, and that's going to be right above our sell call, and for that we're going to get the 35.35 call. And now we're going to have to pay 18.35 or $1,835. Now we have to pay because now we're buying something. Now the difference between these two is going to be what's known as your call credit spread. We're going to get back into that in just a second. Now, this option strategy is known as the call credit spread, as you see up here. And once again, if you do this strategy and you do not see it says call credit spread, I advise you to do it again. You did go wrong somewhere. Now, once you do this strategy, you're going to receive a total credit of $155 into your buying power. Now, that money is yours to keep no matter how this trade goes. Now, I will explain how you win this trade and how you lose this trade in just a second. Now, let's go into the spread. So the second part of doing a call credit spread is going to involve leaving a collateral. Now, that collateral is going to be determined by the spread. Now, what do I mean by the spread? The spread means the spread or the distance between your two strike prices. So between 35.30 and 35.35 is going to be a $5 spread. So that means your spread is going to be $500. Now, how do we get the $500? Well, as you know, each option contract is multiplied by 100 shares, hence the $500. So that $500 now is going to be your collateral. So we're going to hit continue. We're going to choose the amount of contract. We're going to hit review, and it should tell me I don't have enough buying power. Let's just see. There you go. But you are able now to see the collateral. Now, you do see fluctuations in the price. That's because at the time of making this video, the stock market is pretty much still open. So here we have it, minimum credit right away and your collateral as well. So how do you win this trade? Well, if on your strike date of September 24th, Amazon is trading at 35.30 or below, then you get to keep your minimum credit and you get to do this trade again for the following week because now your collateral is going to be released back to you. Now, the other way this trade could go, once again, if September 24th comes around and Amazon is trading at 35 or higher, then you keep your minimum credit, but now you lose your $500 collateral. Now, there is a third way in which this strategy can go. Now, if again, on September 24th, Amazon is trading at any price between $35.30 and $35.35, then you're gonna get part of your collateral back. So why would you want to do a call credit spread? Well, I use a call credit spread when the market is very hot or the stock is trending upwards. Since the stock has a big incline, I think my chance of winning is going to be a bit higher because the stock only run up that much. But that's just my personal preference. Now, why would someone want to use a call credit spread instead of the other strategies out there? Well, as you know, not everyone has a big account. Now, if you're trading with an account with like $1,000 or $2,000, then a call credit spread might be the way for you to go. The reason why is that you could use this collateral of $500 and do several trades. If you were to take your $500 and do one of the other option strategies, then your $500 may be locked up for a while. So now we're going to go back to chance of profitability. So let's get rid of this here and we're going to go back over to sell and call. Now, chance of profitability is so really important. Now, on this channel, as you guys know, I like a chance of profitability of 75% or higher. You as an individual can choose any chance of profitability based on your risk tolerance. So if I wanted to make a lot more than the minimum credit which I received, then I could always reduce my chance of profitability. Now let's go down. For example, I'm going to reduce it to 73%. And for that, we're going to get a 35.20. Now I'm going to go ahead and buy another call to see if our minimum credit will be increased. So let's go to buy again. And there you go. So previously our minimum credit was $155. By me reducing our chance of profitability, it went up to 1.8 or $180. So do as you will with the chance of profitability. Whenever you're choosing, make sure it's based on your risk tolerance, how much you're willing to lose or how much you're willing to spend. Now, there is also another way in which you can increase your total credit. So let's go ahead back now. We're going to go back over to sell and call. Now, in order for you to increase your total credit now, we're going to go back to buy and call. And now we're going to skip one strike price and go one higher. So we're going to go from 35.20 and we're going to skip 35.25. And now we're going to go to 35.30. We're going to hit that one. And there you go. So now your total credit is pretty much doubled. Now you're going to be receiving 3.4 or $340. Now, in addition to the total credit increasing, your collateral is also going to increase. So let's jump into continue. We're going to choose the amount of contract. And now it's going to show you your new collateral. So your new collateral is $1,000. So with the increased credit, you will also have to leave an increased collateral. Now, this option strategy is extremely simple, and I'm going to run through it using a different stock. Now, let's go ahead. We're going to do the same call credit spread, and we're going to use SPY. Now, as an option trader, I can assure you there's only one sure way to learn with option, and that is getting down and doing it with option. It does not really matter how many books you read or how many videos you watch, you have to practice. And once you practice, you will lose some money. But make sure the amount of money you lose is the amount you were willing to lose in the first place while you learn to do these strategies. So what I'm going to do now is that I'm going to go ahead and do a call credit spread. A call credit spread will literally take me less than 30 seconds. So here we go. So once again, we're going to go to sell and call. We're going to choose our strike date, September 24th. Now we're going to start off again by looking for a chance of profitability of 75% or higher. Now with the 75% chance of profitability, that's going to give us the strike price of $4.51. Let's go ahead. We're going to hit that. We're going to go over to buy and call. We're going to choose our strike price right above at the $4.52. We're going to hit that. We're going to hit continue and voila, call credit spread. Now in this case, we're using the SPY. So now your minimum credit is going to be $31. We're going to hit review order. And then it's going to tell us how much collateral you're going to need to leave. And there you have it. So your collateral on the SPY is going to be $100. Now, we have lots more strategies like this on this channel. So if you want to join the weekly income team, like and subscribe right now. Also, hit the notification bell to get an alert whenever I post a video. But most importantly, if there's someone out there you think that can benefit from this content, please feel free to share it with them. Let's help as many as we can. Thanks for watching, and remember, always keep pushing your investments.